Ensuring stability of prices. This is the primary objective of the Central Bank of Armenia. And for its fulfillment, the Central Bank elaborates, approves, and implements monetary policy programs. These programs imply a steered policy to achieve the target inflation indicator. The document includes indicators of the real, fiscal, monetary, and external sectors of the economy. The Central Bank of Armenia has moved to an inflation targeting strategy since the beginning of 2006. Prior to that date, the monetary policy had several development stages. In 1993, for instance, soon after the final collapse of the ruble zone, the number one objective of the country's monetary policy was ensuring internal and external stability of the national currency, the dram, only. That was just put into circulation. However, structural problems existing in the economy hindered the achievement thereof. The situation changed in 1994. This date was a landmark in the history of Armenia as the beginning of an effective anti-crisis policy. With the view of implementing the monetary policy, the central bank started consistently handling the money supply, that is, the monetary base and the broad money. Monetary base. Broad money. The existence of a certain relation between the money supply and inflation allowed the Central Bank of Armenia to increase the effectiveness of inflation management. The program defined indicators of both the money supply and inflation. The first success story did not take long. Due to the inflation management through money aggregates, as a result of implementation of the 1995 monetary policy, it became possible to decrease the rapid growth in prices to 32.2% as compared to 1,761% recorded in 1994. The structure of broad money and the relation to inflation were changing over time. From time to time, the bank was facing a challenge of choice: to maintain the target level of inflation or revise the monetary program indicators. And no matter how the board was governed by the objective of ensuring inflation level determined by law, it ran into lots of criticism, a phenomenon with which monetary authorities in all countries encounter. Perhaps this is the right way to stability and long-term economic growth. With a view of avoiding variable expectations formed in society, the central bank made a choice of principle: prioritize inflation in the monetary policy program by adhering to a new strategy of inflation management and provide straightforward impulses to society. The inflation targeting strategy defines: the inflation targeting is a monetary policy implementation program which is characterized by public disclosure of official, operational, or intermediate inflation indicator for 1 year or a specific period, by stating that ensuring of low and stable inflation is the primary long-term objective of the monetary policy. The short-term repo interest rate was adopted as an operational objective of approximating the forecasted level of inflation to the targeted level. Definition of repo: a short-term interest rate at which financial market participants sell securities to each other with a commitment to repurchase them, or similar other securities in the same volume in the future. The Central Bank Board sets central bank refinancing rates for each month. To make sure its activity is understandable to the public and the banking system, the Central Bank publishes once a month a press release on establishing Central Bank of Armenia interest rates, on repo interest rate for the coming month, with a brief summary of discussions at the Central Bank Board meeting. In the following 10 days, the minutes of the Central Bank Board meeting is published, introducing the analysis of development of economy and financial markets and inflation forecasts. Economists use numerous inflation indicators. The Consumer Price Index, CPI, is set as a basis for calculation by the central bank, since it is more comprehensive for people. In Armenia, the Consumer Price Index represents the change in prices of 470 consumer goods. How does the refinancing interest rate put on a straitjacket on the market by preventing the inflation? Banks always have shorter yet recurring liabilities, and at the account of such liabilities, they are able to cover longer-term assets. It is due to this very scheme that, by changing the short-term interest rate of the money put into circulation by it, the central bank can influence longer-term relations, making them more expensive or cheaper. The mechanism is as follows. When prices go up, the central bank increases the interest rate of short-term refinancing. For commercial banks, this implies a rise in the price of attracted money. Therefore, banks, in turn, increase the interest rates of loans offered to their clients, individuals and businesses. Borrowing from a bank becomes difficult, not profitable. Therefore, very few agree to borrow expensive money, to buy an already expensive commodity. And conversely, when deflationary events occur, and there arises a need to prop up the economy, the central bank will lower the refinancing rate. In this case, many would want to borrow. Nevertheless, often the cost of money is extremely expensive. This is the thought of American philosopher Ralph Waldo Emerson, which is hardly meant to be related to monetary policy and high interest rates of refinancing. Nevertheless, the fact that at times money seems extremely expensive is beyond doubt. In the central bank-commercial banks relations, the central bank applies various tools. To ensure liquidity, it uses repo, swap, buyback of securities. And to limit the quantity of money, adverse repo and security issuance. The law also provides for the application of standing facility instruments, which form upper and lower borders of interest rates of monetary policy instruments. There are two of them: attraction and provision of monetary funds, that is, the deposit facility and the Lombard facility. In addition to the elaboration of monetary policy programs, the central bank workgroup in charge of forecasts submits to the central bank board's consideration inflation forecasts, deviations from the target indicator, and ways of how to adjust them. Based thereon, the board determines also the quarterly directions of the monetary policy. When elaborating the draft monetary policy, the central bank consults with the government, assisting in achievement of objectives ensuing from the economic programs of the latter, provided, however, that they do not contradict the objective of price stability. Monetary policy programs are open to the public. Each year, by May 1, the central bank submits, as information to the National Assembly, a performance report on monetary policy program for the previous year. To keep inflation low in the economy, amidst a floating exchange rate, liberalized capital, and financial account operations. These are the central bank's current basic principles of monetary policy implementation.